Welcome everybody back to our webinar series, Developing Superb Trading Strategies. My name, Stefan, as always, today we have the 16th of March 2017. Same time, same place, and same people around. That is nice that you come back always here to our webinar series, and thanks to Algo-Trading who makes that webinar series possible. Yeah, as always, I have to mention the risk warning because we talk about trading strategies, but you have to know that whenever you do something finally in your own account, of course, you do it on your own. And I know that you know that as well. Very good. As always, next announcement here is that you can find all the slides in the GoToWebinar control panel. So slides are uploaded, so that means you can download the slides if you want. Then you have all the links, and especially the link here to that YouTube channel, because there you can always find all the recordings of those webinars as well. Good. So topics today, of course, question and answers from last week. There is nothing to report, but I want to comment a little bit on what happened yesterday. You know, yesterday was the Fed interest rate decision. I do not really want to comment, but it's always nice to look on the charts and see what happens at those news events. And then we go into two topics for today. The first one is related to so-called Renko Charts, which is a quite interesting other way to look on candles or on prices of any underlying. And that is, I think, really interesting, and I will introduce that concept here. It has a little bit to do with our previous analysis, which was triggered by the reverse trading, but the relationship is only, let's say, quite weak. But I will tell you later. And then we don't want to go on with the reverse trading, but we set up exactly one question out of those kind of analysis, and we built up some hypothesis, and that was, hey, maybe it be possible to find a good trading edge, so a probability advantage out of those kind of considerations. And I promised already that the answer is yes, and I will show some analysis today. Good. First, so no, not about the questions, but looking to the charts of yesterday's event. And let me, I go here first to the right. That means always I have to shift a little bit the GoToWebinar control panel. Maybe you have the same, let's call it problem. But anyhow, so we have here the Euro US dollar chart, and that you know yesterday's decision point was here. So that is the 7 p.m. German time. You might see that in the button that in the lower end it indicates 8 p.m., but that is a broker time of Algo-Trading, so the line is right. So what we see here is simply that yeah, we have a huge increase during the next couple of minutes after the release of the information that the Fed has increased by 0.25% the interest rate. Why do I mention that? Simply, yesterday, before that interest rate decision, there was already a lot of news, and all have been more or less of the same opinion. So it was to 95% expected that the increase of interest rate will happen, and that decision is already within all the prices. And you hear me already laughing, because if I read sentences like that or statements like that, then my personal question is, okay, if everybody has already, let's say, incorporated the expected decision in the prices, then there should be no price move. So only if something would happen totally different, of course, then I can understand that we have a new situation. But that means all those nice sentences, nice statements, I don't think they have any truth, but because we see what happens here. And the other thing, now it's not related to those kind of statements, that's more related on what really happens after those kind of decisions. So it was a decision in United States. So mainly, for example, for those 6 currencies here, the one in the right lower end corner, euro, US dollar, should be the most affected currency. But what you see immediately, that's not true. All currencies have been show some effects, and what's really nice that after that kind of decision, those kind of reactions are really different. For example, here, if you compare Euro Japanese yen to Euro US dollar, you see a sharp increase in Euro US dollar, and Euro Japanese yen went down. Yeah, but just already a couple of minutes later, the Euro Japanese yen was totally recovered. So the price went back to more or less the origin before Fed decision, whereas Euro US dollar moved even further into the direction which have been taken exactly at the point of the decision. So you see completely different reactions, and I don't have a real clue on why, and I may have some arguments, but anyhow, finally, I don't know. For me, it's always interesting to have those events, to see how market reacts. And by the way, what I would like to mention here as well is you see the 6 charts, and yeah, they are scaled as MT4 would scale them, and that's always auto scale. And you see my blue boxes in all the 6 charts, and those boxes help me to identify, hey, where can I find the currency with the biggest movements, because those boxes have a percentage height of 0.1%. So every box has the same height, but in percent. And now it's what I have to do in order to see all the charts in, let's say, really the same scale. I have to rescale the charts in a way that all the boxes have the same visual height. That's now about, and then you can clearly see that in Euro Swiss franc there happens more or less nothing. But we have currencies like Euro, Australian dollar with huge movements, and yeah, for example, Euro, US dollar as well. Euro, British pound is much less affected, as well as Euro, Canadian dollar. So that helps to scale in a way that you really see the movements itself. Good. But now back to what I promised here, that I would like to go into another kind of chart, because that kind of chart helps yeah, to better see the real market movements. To investigate that kind of chart, that was, as I mentioned, a little bit triggered from my previous analysis about reverse trading, because when I have done that, I introduced the concept of okay, I don't want to open trades every 5 minutes because everything was based on M5 charts. And I developed the concept, okay, if the price does not move in the following candles very much, then if the price does not move very much, and I use as a limit a multiple of the ATR, then I don't open any new trade. And a little bit similar is the concept of so-called Renko charts. I will explain it on my next slide in much more detail. But first, let's have a look to the chart here. So, in principle, it only has two kind of boxes, rectangles, and all the boxes have the same height in price. And in this case, it's 22 points. For euro, US dollar, 22 points, should be 2.2 bips in this case. But anyhow, and what you see here is always, yeah, you have either one blue box after the other, and that means we have an uptrend here, a clear uptrend, and then sometimes we have red boxes, meaning price goes down. And the definition here is simply that one of those boxes that you finally don't know how much time it's related to such, let's call it not really a candle, but a box. It might even be that one of those boxes would represent several hours. Why? If the price does not change by more than the 22 points, then there will be no new box. Only if the price from the upper part here, so let's where my cursor is right now, so only if the price goes up additional 22 points, that will create a new blue box. And if the price goes down up to here, if the price would have went down up to here, then it would have created a red box, but only then. That means those bricks, and they are really called bricks, those boxes, they represent a price range. And the time information get lost. But what is more important, the time or the price? Especially if you think about charts, for example, if you look to M5 charts or even below, then during the night, for example, if nothing happens, yeah, you look to a chart which is simply horizontal, moving up a little bit, moving down a little bit, but nothing really happens. So why, let's call it that way, why the hell should that horizontal behavior be represented by hundreds of candles? So better to have only one candle with a certain price range. Finally, that kind of charts are much more clear in the price movements. So you can much better see horizontal resistance lines, for example, or that typical behavior like a chart analysis, going up, going a little bit down, going even further up, going a little bit down, and so on and so on. You can see that now automatically within that kind of chart. So the overall definition of Renko charts is the following. So Renko charts are based on what they call bricks. And those bricks is the only parameter for that charting tool. and I will show in how to create it in MT4 by an example, and then you see the relationship between those, the one parameter and the outcome. In principle, Renko charts really need tick data to be represented or built correctly. And there are some certain expert advisors which really do that kind of job. We later will use only a so-called indicator. And the outcome of that indicator is, by the way, exactly the chart I have had on my previous slide. Indicator, or the creating or the building of that kind of Renko chart is not 100% correct because it does not use really tick data. They use, you simply go for the smallest time frame you have, that is in MT4 just M1, and they are not built 100% correctly because there might be some ticks going that way up or down that already would be needed for a new brick, but in principle it works quite well. So, but let me once again summarize what kind of information do we have. So we lose the time information because everything is only price-based. So in the beginning, those charts really you have to get used to it because it sometimes looks crazy because you because you lose the time information, but you gain a better chart information. And since the price is more relevant and the price changes than the time, therefore I think it's a quite good way to look at charts. In principle, there's a question of what are good brick sizes for that kind of charting, and I think there are only two kind of ways which are really suitable and really good, and those two are one is based on an ATR, so that you correlate the brick size with an ATR, or the other way would be that you think about a percentage value of the price as being the brick size. The advantage of that one is that since our trading is more percentage related than anything else, at least for those who use, for example, constant risk and derive their lot size for every trade based on that value, then the percentage movement is more relevant for everything. And that means if we have a brick size with a fixed percentage, then if you look for different underlyings, so multiple chart considerations, then this would be a very good choice. But keep always in mind that the x-axis is not anymore a real-time axis. Still, the time goes from left to the right, but the bricks may represent hours or only seconds. That finally you simply don't know. When I create such a chart, a lot of things might be more obvious now. Let me do an example here for euro US dollar, and let me get this one here. Let me get rid of the indicator, and then we have, for example, that chart. That is an M1 chart for euro US dollar. Okay. Let me just do a second one, because then it will be later a little bit more meaningful to see both charts simultaneously in order to get the differences of those two ways of representing the price versus time. So now we have the two M1 charts, so quite exactly the same. But now I use the Renko chart indicator, and you can download that indicator on hundreds of web pages, so it's no big deal to get it. And what you have here is simply just one number. You can change the colors, but anyhow, let me start with a brick size of 20 points. And now you see the chart here, and we have exactly that chart. And already now we have really to think about those two charts, where we are. Okay, finally the price is here. Okay, and you see in the short-term history, the last couple of bricks here, some blue bricks, meaning going up, and those bricks represent exactly within the original chart that behavior here. And by the way, in the lower chart you see still a time axis, but that time axis is labeled absolutely wrong. So don't use that time axis for anything. Because now I want to show you that you have really to get used to that kind of chart representation, because I think you might already try to compare the two ones here. And the point is, and you might think that this point here, I leave my mouse for a moment here, that this point is related to that point in the upper chart. But you're wrong. Within those bricks here, or in those candles or representation of that chart, we have already much more history than in the upper one. You will see it in a second, and you can realize it already if you look here to the scale. That scale goes up to 1.0751. And you see, wow, the upper chart here does not have that values here. But if I de-zoom here, now it becomes a little bit more obvious. Let me go back here. Because that point here is exactly that point. Those two are related to each other. And that is not really obvious just by looking. But the good thing is, you see, for example, that kind of behavior here, a long time happening nothing. Yeah, that will be shrinked in the Renko chart because there are no new bricks to build. And therefore, of course, from here, the price goes down, and that is a sequence of those red boxes. But finally, the long-term sideward movement is now only some bricks up and down here. And that part here, that strong down movement, is exactly represented by that red bricks. I know that coming first with so-called Renko charts is a little bit crazy, because you get lost, or you think, hey, I don't have all the relevant information for my personal trading. But the more and more you look to those kind of charts, they become more and more interesting, believe me. And what you can do is you can, of course, change the brick size, for example. Let me change it, for example, to 10. And then it looks really much more different here. And still you see some relationship between the two charts here. So that W is really that W here. So they are time ordered in a, let's say, normal sequence. But still, that point here is that point here. So we have more information, and we have more relevant information within a Renko chart. At least that is my conclusion up to now. And it's really interesting to have the right box sizes, and then it's much more obvious to see the relevant movements. You can better see side ranges or side up and down ranges like this one here. And so things become, at least from my point of view, a little bit more obvious. One last remark on the Renko chart, because you see that is built here on M1 candles, and that not on on real tick data. Therefore, sometimes you see that the last box here goes up and down, but so it might change the behavior, but that's always only the last one. One last picture for Renko charts looks like this one here, because now I have prepared my standard charting here for my 6 currencies, all euro based, and second name is Australian dollar, and so on and so on. And now I have a real good view on those 6 currencies. And by the way, as I mentioned, in principle, I look to 21 currency pairs just by looking to those 6. I have my box selection is based on that percentage value of the current price. So percentage-wise, all the boxes have the same height. But now you can really see the differences, and you can better understand the behavior of the currencies just by looking to those Renko charts. For example, the behavior of euro Swiss francs is now much more clear than if you look to the original standard chart. So it's not that bad, but you have really to get used to it, and it's not obvious from the first view, but after a couple of days you like it. At least I like it, because I have those standard movements which are represented by those bricks here. Good. That's for Renko charts, and reason for introducing it is because that fixed brick size, meaning a fixed movement, is a little bit related to my ongoing analysis of searching the edge, because I go through the chart or through the data, more or less in a way like going through those bricks. If there is no movement, at least in my standard value is 5 times ATR. If there's no movement more than those 5 ATR values, then I don't open a new trade. Simply reason, because I think then the chart has not really changed. So I don't have what I would call a new situation. So if price goes flat, horizontal, then I don't get any new situation. And therefore, I like that kind of charting as well. And that was a trigger for entering here into that kind of discussion. Good. Second topic is now this searching an edge. And the reason for searching an edge within price information of the history is quite simple and obvious. Because if I find whatever kind of relation between some history behavior and a preferred direction in the future, then I have something which is a real trading edge, and that can be used for any kind of trading activity. So, and last week I used the assumption that there's a relation between a rate of change. That means rate of change means looking from now to maybe 10 candles back, or 20 candles or 100 candles, whatever. So the rate of change has as a parameter a period or simply a number of candles, how far you go into the history and look for the price change. And the question is there a relationship between maybe a specific rate of change period and rate of change values with what's going on? And last week I called it "and a good trade," and that trade might have a risk-reward ratio, a stop-loss multiplier, and that's it. But now I changed a little bit my assumption or my topic or what I want to analyze here. And that has to do with different kind of trading principle or strategy at all. I rephrase my assumption a little bit. And on the next slide, I will explain what I mean with a different trading philosophy or trading strategy at all. And now I simply ask for the question, is there a relation between a rate of change period and the short-term future price movement? So what does it mean? I don't ask here directly for a trade, which maybe has a stop loss and a risk-reward ratio. No, I only want to know, let's for example say in 8 candles on M5 base or 10 candles or whatever, do I know in which direction, long, short, so upwards, downwards, or flat, in which direction do I have a typical movement? So I don't ask exactly how much, or I don't ask for a trade. The only thing I want to have is from a, let's say, now. I look a little bit back to my history by looking to those rate of changes and asked, can I predict, can I foresee a little bit in the future in which direction the price might and will move? Up, down, flat. If I do have such a relationship, then I can use that information for trading because I have an edge. I mentioned already last time that the principle, the methodology, what we use here is a little bit similar to class trading, but only similar. Before I show you what I really have in mind finally as being the real trading strategy and how to trade if we find such a relationship and how to trade that relationship and really get trades out of that, I will explain in a minute. But let me tell you that all the investigations I will do, or the numbers I will present, how those are derived. So whenever I look for rate of changes with a specific period, so the lengths in the history, I don't look to the real price difference. I look to that price difference in units of ATR. Why? You know, sometimes we have high volatility and sometimes low volatility. So just looking for the real price difference or even the percentage price difference is not enough. I relate it always in units of ATR. And what I change is rate of change periods, and I look into different future periods. So maybe, for example, 5 candles in the future, 10 candles in the future, 20 candles in the future, and so on and so on. So the trading strategy I have in mind finally to implement that behavior or that finding the edge strategy is the following. And by the way, that runs for me personally under the name position trading. And how does it work? Let me simply get you through, then you clearly understand what I do have in mind. Assume that we have something, and that we have now, we look to the history, and whatever we have, but what we have is, it tells us that we expect, so we have a prediction, let's say a huge increase, or stay flat, so not a huge increase, or a huge decrease, so going south. So whatever limits we have, that will be, of course, one important question. But the rules now would be, for example, like, if I predict out of that analysis and looking for the current price, if I predict a huge increase, I would open a long position, of course. If my prediction would be stay flat, then I do nothing. And if I would predict a huge decrease, what will I do? I open a short position. So far, so good. But now we have to think a little bit more in detail. So what if we have already, we want to open a long position because our prediction tells us, hey, price goes up. But we have already a short position. What do we do then? Then we would simply close the short position. Maybe a few of you are already familiar with MT5. That is, by the way, something you can do there quite easily. So you go in steps, north or south. So maybe you have already 5 long positions open, and then you get the signal, hey, I want to, because the prediction goes south, then it's time to open a short position. That would mean, yeah, close a long position, and vice versa, by the way. Of course, that kind of strategy needs a couple of additional rules, and not only those here. For example, we need a step size. Like, for example, we go for 0.01 lots. Whenever we get a long signal or a long prediction, we buy a long position of that size or whatever. Then, of course, it will be needed, or we need some upper limits. So if we get 100 times in a row that signal, hey, prediction is increased, it's an increase, open a long position, then we finally would end up at 1 lot. Maybe that's too huge, so we may need an upper limit, or that might already even be related to some kind of stop loss management, because that trading the prediction still needs a stop loss, because not all the time our predictions will be right. So we need still a stop loss in order to be on the safe side. So a lot of more definitions we need, but that comes later. But it's a more, let me rephrase everything totally different. What you would do here is a complete different kind of trading. It's more like we make a decision, and the decision tells us price goes up. So then, therefore, it's good to open a long position. In a normal trading, you have maybe for that single trade a stop loss, take profit, and so on. But what does it mean to have a stop loss and take profit for that single trade? It only means that for the future, you set a certain condition, a price condition, for the time that trade should be closed. So in principle, for example, if the price goes up and up and up, and you open a short trade, then finally your stop loss will be reached. Why? Or what is the more logical behavior? Yeah, because you have made a conditional decision, because you relate that stop loss to a price, and if the price is reached, your trade will be finished, and in this case, it's a stop loss. going for that position trading, you have a little bit different view. The view for that kind of trading is that with every new tick, for example, or every minute or whatever, you rethink the market. You rethink your expectation. And if your expectation changes by, let's call it a certain amount, then you change your position. So it's not like opening a trade now, setting a stop loss and a take profit, and even may have some rules for changing around stop losses, like trailing stops or whatever. So don't set conditions for that single trade being closed for stop loss or take profit. No, now we go with the market or with the price movement and ask ourselves all the time, what is my expectation, what is my prediction, and we react in accordance to our expectation. And if our expectation changes, we change our position. So that's the way here. So it's a little bit different view on trading and all. There are a lot of more things you can put into that kind of trading activity or trading sequence, trading behavior. So it's, yeah, in general, a little bit another kind of thinking about trading and all. But now let's go for the analysis I have done in Searching the Edge. So I know it's sometimes a little bit complicated, but you will immediately realize what I really have done here. Let me enlarge it a little bit, but we only look at numbers, so it's not set super interesting. But anyhow, what have I done? Let me start here in that column. So here we have the period of rate of change. So now this rate of change period is simply 1. We have later higher numbers. So it's just looking one candle back. Of course, then we look for the last, for example, 300,000 candles. And we look how, we look for the values of the rate of change. And then we divide everything into 10 columns. 1, 2, 3, and so on. And those 10 columns represent classes, so value ranges for the rate of change in the history. What does it mean? For example, in the class 1, we have negative numbers. So numbers like, maybe, just do an example, like 10 ATRs, minus 10 ATRs would be that class. Or the next class would be minus 8 ATRs. So whenever the rate of change looking backwards is in that class, we remember that value. And that goes further, maybe up here until plus 10 ATR. So we normalize, we build different classes for that rate of change period. And then we ask, hey, how is the future? Looking from a specific class, so for example, if we are here at minus 10 ATR rate values for that looking back, so that would be a candle, an M5 candle, because everything is M5 based, which is huge but negative. so a big short candle, and all the quite big long candles would fall into that class here, and those would be around 0. So that we don't have a big candle at all. And what does that number now tell you? That number tells you that is the typical behavior, the typical value of the next candle. So the future candle, or in this case, to be exactly, it would be 8 candles in the future. And now it becomes interesting, because if I just draw that graph here, what does it tell you? Just looking to that graph, it means that whenever we have huge short candles, so negative candles, but they have to be huge, then in the near future, the price goes down further. That is the meaning of that graph here. And vice versa, it's true as well. So whenever we have a huge candle, also a huge rate of change, in this case just only one period, so 5 minutes. But if we have huge positive candles, rate of changes, then the prediction for the future, or not only the prediction, the future from that candle onwards is typically upwards. Wow, that looks interesting. And in between, maybe we don't have that much movement, and we don't have that much relations between the history and the future. So what we see, what we realize here is already what I call an edge. Because now I can use that kind of information for, let's say, trading or looking for the future. And whenever I have a candle or a rate of change in the history which is high, then I would expect a movement to the north from that point in time. And now I have done the following. Out of that line here, or out of those values, I look for the maximum value, but the maximum absolute. And in this case, it would be this one here to the left. So this one has a, let's say, highest value. In this case, it is a quite negative number. And what I've done now is simply, I looked here to a certain history, starting at a point in the history, going up to that candle, and from that point, I went to the real future, because that has not been part of my analysis. So you remember that's that move forward methodology once again. And for the next coming candles, so what those candles which follow the investigation period, which now the next candles, they are not part of that investigation period, I applied that rule. If I find a rate of change value, period 1, which falls into that class, then I'm not really saying I open a short trade, that's not the right wording, but I expect that it goes south as well in the future. And that is exactly what I have done here. So I have started and I get the values for the future. And I sum up all those numbers. So it is applying that rule, and the rule is based on always that kind of analysis, and apply that rule for the real future, and look, whenever I have that kind of expectation, then I expect a certain movement, and so on and so on. So finally, if I go down here, those values, and I would plot them, then this is the incorporation, applying those rules to the real future, and do that step iteratively. Everything I know sounds a little bit complicated, but what I want to do here is I want to use my analysis and apply that analysis to some future, and then go iteratively through all the nearly 1 million candles here. And if I have a line which goes up here totally, hey, that's good. That means that in the majority, my predictions are right. And the sum of all those predictions and applying that kind of rules is positive. And by the way, when my expectation, for example, is price should go down, then finally I count that number positive. So like in the trading activities, like you open a short trade, and if the price goes really down, then you get profit on your account. So the sign of is always matched. So what I have here is an increase. So it means applying all the time that kind of rule, it's right. It's looking good because I use that information iteratively in the future. And one other graph here that you see a little bit how that is working here. Every line represents a certain history, and then that history is shifted like the move forward methodology. And if I now plot something like this, then you see the temporal change in the history, the temporal change, how that kind of relation is changing over time. And what you will see is that this relation does not really change that much. So every row here, every line represents a different part within the history, but always we have the situation that the class 1 here, so whenever we have high negative values for the ATR, the expectation for the future is negative as well. So therefore we have that kind of relationship here in every line, and does not really change that much. What else is in that kind of Excel sheet here? And by the way, the Excel sheet is not, that's the outcome of my C programs. So the Excel sheet does not calculate anything. It's only the outcome so that I can analyze everything. If I go here to the right, and I go back here to the very end, then you see, for example, okay, now I analyzed the rate of change period 100. Once again, I have those 10 different classes, meaning I have different rate of changes falling into one of those 10 classes. And we can ask ourselves, do we have, once again, that nice relationship here as well? And if I plot it, and we see the answer is No. So that means, in principle, looking for the rate of change period 100 does not help me in order to predict the future. That's what that kind of graph is telling me here, because there's no clear sequence or no clear alignment. In principle, I don't care about each box here directly. What's more important is that we have a general relationship or a better matching. So outcome or conclusion from that here is a rate of change period of 100 does not help me that much. Okay. What else have I done already? One additional step here, just that you know, for the next couple of graphs I will show you. What I have asked myself is, still, even if it does not work that well here, like that rate of 100 back-looking period, I can simply apply the same kind of rules, like, hey, which one of those here has the highest value, so highest negative or highest positive value, and then take that one as a rule for the future trades, and so on and so on. So now I can do it for a couple of different periods of rate of change. I use the sequence 1, 4, 9, 25, 33 up to 100, and you see I use quadratic behavior here for the different rate of change back-looking periods. And I can sum up all those trades as well. So applying all the rules. And then I get something like an equity line here as well. And this behaves quite good. There are much more details I would like to share here with you, and I want to show you only a few results right now, that you get an impression of how that really works. Just one example first here. It's a huge graph now, and I think you might get lost on the first view here, but let me guide you here. The different lines is simply the different rate of change period looking back. So for example, the green one here is a rate of change at a look back period of 4, and then finding the best one, applying the rules for the future, and so on, then this is the equity curve. And for example, one of those here is higher rate of change periods, and we don't see, or we don't get that equity curve going up, meaning we don't have that predictive power out of too long rate of change back-looking periods. That's already good to know. Finally, we can apply all rules together, and then we get an equity or a prediction equity like this one here. And that already does not look that bad. Now I have to analyze a lot of parameters here which are involved, because as you remember for our walk forward methodology, there's always a question of how long should be the back mirror should be, or what is the step size, so by stepping through the complete history, and so on and so on. And I've done a lot of work for that already, and I will show you in the next webinar. But let me exactly show you one as well, one graph here already today, and that is this one here. Those are 3 major currency pairs: Euro, US dollar, Euro, Japanese yen, US dollar, Japanese yen, all with the same kind of rulings, kind of analysis, and so on. And by the way, we look 8 candles always here in the future. And we use the different rate of change back periods. But in principle, parameters are the same for doing the analysis. And what the good thing is, for all the 3 major currency pairs, I have, now let's call it an equity or a prediction equity, which does not look that bad. So it's really promising. So finding the edge, answer is already yes. We have found an edge by comparing rate of change periods in different classes. Whether that edge is already enough to finally have trades with spreads and costs and commissions and swaps and so on. Simple answer, I don't know. But the edge is already found by looking to those rate of change in the history and building those classes where do I found the best relationship. So that's for now. You can expect how it goes on, and that we have to do here much more, because it's already looking quite interesting, because we found an edge and now we have to really apply something like those kind of trading rules in order to get a real equity and not only a prediction equity. That's for now. More details next week. And I know it might be a little bit complicated what we do here right now, but I hope you can follow me and you like it. And more details or next steps next week. See you and have a good time. Bye-bye.